following presentation is for educational purposes only. All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.
Joining me live, Thiru Nagappan, Master of the Markets, live from, you're in England, right?
London, that's right. You got it right. Yes, that's right.
Well, no, it's important because you're probably my second best friend. No, third. No, you're second. You're second in London. I have to put Gavin first. Only because
yeah, you have to. You have to. You definitely got to give credit to the legend.
Well, and I have to get Richard up there also.
Oh yeah, that's true. Of course, yeah. We can't forget Richard. They
Right.
come in twos, don't they?
Just to remind everybody, you actually are here with us because you met Gavin at a trade show or something like that.
That's right. You know what? It's interesting. I always reflect about this, and me and Gavin always talk about this as well, is that we've known each other for 8 years, right? But it's just been on and off through trade shows and everything. We connected, and the first time he met us, he thought, hey, hang on a minute. How come this company is called Master of the Markets? Did they copy Tom Williams' book, right? So he came over to our stand, and then he spoke to us, and then he realized that we didn't copy. I mean, it was just a coincidence, but there are no coincidences in life. But only 2 years ago, we started working more closely together and combining our methodologies because they are so complementary. And in fact, Jim, it just blows our mind away. When I first came on the show on NinjaTrader just 1-2 months ago, and I did with Tom, when I showcased the entire thing with the volume, and Gavin and I came again to talk. I mean, yeah, it is so complementary, the methodologies.
Yeah, no, that's awesome. It's awesome that you're here. It's awesome we met you. I know you've been a guest on the show with Tom several times. And so just give me a basic, though, principle of how you look at these futures markets.
So as I told in the earlier presentation, I mean, I'm going to refer quite a bit to Tom's one that we did. I mean, I always put you in a competitive mode when I say, yes, we broke the internet with 25,000 views, you know, with the first one. This was the one, guys. I mean, guys want to refer to that because I'll refer to it quite a bit because I can't go through the stats side as much as I want to.
By the way, but I mean, it's kind of not a fair fight. I mean, Tom is a CMT. He's smarter than me. He's got better hair, the whole thing. So, and it might be the hair alone that just does it for him. I don't know.
Yeah, maybe. I don't know. I'll let the audience say that. They can comment in the chat box. We can find out. But whatever it was, so anyway, I mean, coming back in a nutshell, if you want me to just say in a nutshell, what we have done actually is this work actually, I can't take full credit for this, Jim. I said this in the previous interview as well. This work actually started in the 1960s. Again, there's no coincidence. I met my mentor in actually Ascot, Royal Ascot. Do you know about it? It's like a racing horse place kind of thing. I don't play horses, but I was invited there by a broker. So I met my mentor by chance, and just a quick interaction with him, I knew that guy, he was a quant. And when you know someone is a quant, they talk very definitive. It's not subjective. They don't say if and wish and depends. They don't use such words. They are very, very specific. So I was actually looking for something which quantifies a top and a bottom. I was looking for a framework. And if I want to be technical, the word is actually called market structure. So when I was in the Society of Technical Analysis conference just a few weeks ago, and I was invited to talk there on basically this as well, and you can see this nice picture over here with me and Gavin when I did the talk, as well, very similar to what I did with Tom. You can see that even over there, Linda Bradford, which most people know, the new market visits lady, she talked about market structure as well. So all we have done in a nutshell, Jim, is we have quantified market structure. My mentor gave us the formulas for how to quantify a top and bottom, which they started to do the research in the 1960s. where we quantified what a top and bottom is. And there we go. And what we have is all this now, this orange and blue arrows overlaid with the volume indicators with Trade Guider and Gavin Holmes and his team, which is what we have. That's in a nutshell. It gives you a really quantified market structure where we can start to look at different time frames and what the trends look like and all of that. And it gives us incredible stats and specificity and clarity. That's what it does.
Got it. Did you say Linda Bratchford?
That's right. Yeah.
She used to be a bodybuilder back in the day. I don't know if you knew that.
Really? I never knew that.
Yeah.
Okay, yeah. I read the Market Wizards book. All I know is that she has got a muscle something disorder, but her motivation and determination is another level. Yes.
Yeah, no. Yeah, right. Best of the best, been around forever.
Yeah.
Okay. So, all right. So what are we looking at here? We have a couple of charts up here on the screen right now. This is you're incorporating, I could tell you're incorporating Trade Guider as well into the NinjaTrader software.
Correct. Price and volume. You can't argue with that, right? Because it's like fuel in the tank along with the direction that price gives us. I think the main thing today, Jim, I really want to impart to the audience, and I was watching you and Tom present as well earlier. I want to take a look at the gold charts today, but mainly for the audience today, what I'm going to be teaching is you can apply to any chart. A lot of people always talk about trends and time frame correlation. But what I've struggled to find in many presentations is a quantified market structure to define trend specifically. I'm not saying it is the holy grail, but some kind of a structure, some kind of a framework, right? And that is what I want to impart to the viewers today. And why is this very important? Because, you know, whether we like it or not, Jim, most people are trading some part of a swing, right? On some time frame. You know, on a weekly, it might be this swing that you're looking to capture, and you're looking on a very small time frame, but looking to just capture that tiny part of maybe a weekly swing, which is about to finish off. So understanding where you are in the swing is very important. Another thing very important.
So Thiru, real quick, just so I can catch up. So there's two components, right? There's when you're in the trend, and then when the trend ends.
Correct.
Those are two things to identify.
Correct. Not only that, I'm going to break it down really even more specific, right? But one more thing people also need to understand is the nature of how markets move as well, Jim. You will agree with me on this, which is no market out there, pull out any chart, right? I mean, ETFs, bonds, commodities, nothing moves in a straight line. They've got to swing back, right? It's just the nature of the market. So it moves in cycles or it moves in swings. Now, if it moves in swings, we'll agree that it will make a top and a bottom. And once you quantify what the top and bottom is, you have a market structure. And going back to what you were talking about, so let me just break all this down quickly. And I also know about the time as well that we got. So over here, if you really look at this, right, what makes up a trend? The cycles make up a trend. One cycle is this, right? 2 bottoms and 1 top. When I compare 2 cycles, then I got a higher high in reference to this high, and I got a higher low here. All right, so that makes up my uptrend. Now, when does this trend finish? When it does a trend change, or institutional term is a regime change. When it takes out that low, it comes back down, and the trend is changed because now you got a lower low. And the critical thing for the viewers listening in is that if you want to define it on a quantitative basis on any time frame, weekly, daily, 4 hour, 1 hour, 15 minute, 10 minute, 1 minute, you need some kind of a quantification. And that is what we mean by market structure. And this was the work that was started in 1960s, where they defined what it was based on formulas, right? So that's what we got today. So basically over here, we've coded everything, and it's all on NinjaTrader as well. So if I were to take them through, let's say, the weekly all the way to the 1 hour. Shall I do that, Jim, on this framework? Let's do it in real time, right? That's what we're here for, real traders, real time. So if you look at the gold contract here, June contract, I'm just taking gold as example. If you can see the trend is up. I mean, if you want to follow this, you can see all the quantification that we have done. This is the volume stuff coming in as well. I will marry that up very soon. But let's get the market structure done. So if I were to connect that up as a line diagram, it would look something like this, right? So it's an uptrend at the moment. But one important thing I want you all to observe is that the swing low was here. And if you can see the blue dot that came in, that was when the bottom got confirmed by our formulas. So if I were to draw this here, my confirmation of that swing came in around that cross point, which is that blue dot, right? So in relation to our bottom at the moment, today we are here, that's the highest point, and it's falling off that. And what did I tell the viewers and the concepts is that nothing can move in a straight line forever, right? So it's got to make a top at some point. But what I want the viewers to understand is this is on the weekly. So it's kind of a little bit overstretched, right? It's quite far away from its bottom. And that's when you got to just be careful that even though it's an uptrend, but it might pull back, breathe out, breathe in, breathe out, right? So you can't keep breathing in all the time, you know, and you got to breathe out. That's why we call it profit taking and all that, whatever you want to call it, retracements, whatever it is. That's when the top is formed. So nothing can move in a straight line. The top has got to form. But if the trend sustains, this counter trend move that we call a retracement, which we call a phase 2, and anything that's in line with the trend, we call it a phase 1. If the trend sustains after the pullback, it should resume back and carry on further to make a higher high.
So I just got to make a comment. You have not used the word correction yet. And I'm taking my hat off to you because I hate the word correction because I feel like the market's always correct. You might be incorrect, but the market's correct. So there's no such thing as a correction. And it's about supply and demand also.
It's just terminologies, isn't it, Jim? I think some people, instead of using retracement, they like to use correction. Some people say, you know, phase 2, you know, is a pullback. I mean, whatever that, you know,
right,
people are used to.
But it implies that the price is wrong. Right.
Yeah, I
it
understand what you're
price
saying.
is wrong.
I understand what you're saying. It also depends what the meaning people associate it to. But if you take it technically, you're right. I mean, correct means if you're doing a correction, that means the price is wrong, which, yeah. Which maybe subconsciously I
just
that. I
noticed
don't
you
want to
didn't
use
use
it.
the word. Most presenters do use the word, and you didn't use it. So I thought I'd just
Okay. I like that. Okay, I won't use it ever then. Because
All
now
right,
that
thank you.
now that I know that, yeah, because it will stick in my head now because you know you don't, yeah, price is never wrong. You're right. Yeah, I like it. Anyway, so coming back, so far, I mean, is the explanation making sense?
Yeah, great.
Yeah. So how do we marry all of this up together for the viewers is that, so we know that the weekly is extended, a top is about to form. Now, as a quant trader, if I were to put that in stats, and I refer you guys back to Tom's interview, you can take a look where I went more deeper into that. But from a stats perspective on the weekly, what's the chance that this top is going to form? I pulled out the stats from our quantification. This is the OE stats. So it's just comparing on a weekly time frame over 10 years, 27 swings we got. All it's telling me is that, viewers and traders, is that to get to a 200-point move is a 7.41% chance. Now, if I go back to our charts over here, and if I use the ruler function here, drawing tools, and if I use the ruler function, from the close, is how we measure to the top is what we got. That's about 318 points, right? Now, to take out that top without confirming it, and then for this to shoot up, according to the tables, to get to 200 points and above, right, it's a 7% chance. So it's much lesser. There's almost a 2% chance you can take out that. So now I'm stacking my probabilities to my side, and I'm saying, you know what? There's a high chance this will fall a bit more to make a top. So that's the first part, right? Which I want to give to the viewers. Now, let's marry up all this time frame correlation. That's what I wanted to tell you guys. 3 parts of the market structure, right? Trend, the uptrend, downtrend, or it's going to be a sideways movement. Let's marry this all up together. So weekly at the moment, it's giving us an uptrend phase 1. Yeah, uptrend phase 1. So it's something like this, right? That's where we are. It's an uptrend phase 1 on the weekly. Now, on the daily, however, I want you to observe this one here because on the lower time frames, you can take a short, but just be careful. Just understand that you're trading a pullback. and in anticipation that that will become a confirmed top in a uptrend move. So here when I come on to the daily, you see, look at this, right? We're marrying up this part to this part here. That's what we're doing, right? And when we do that, if I analyze that a bit more closer, let me just expand the charts a little bit here. We talk all about this much more in detail in 7 steps to CTP.com. So let me just show you guys here. So if I want to correlate all of that, so look at this part here is what I'm superimposing onto here, right? And if I were to do that, you can see that it had a bit of, let me just see, do that. It had a bit of, you see, look, so it had a bit of a pullback here. And that's when people really don't understand correlation of time frames, Jim. When it did this, of a bit of a bounce off, they look at the daily, just uptrend. Okay, let's now jump into this, believing that it's going to go higher. But looking together with a weekly time frame, you and I now will know that it's quite overextended for this phase 1 move. There's a high chance it will form a top because markets move in cycles. And statistically, there's only a less than 5 or 2% chance of it to tick out that high and carry on further. So that will make me more wary and cautious of taking this on a long when I look on the daily time frame. So that's the first thing. So you see over here, but still as of now, technically according to market structure on the daily, this is still a phase 1, right? Uptrend phase 1. That's why I'm showing you that. But I would just be careful of taking that phase 1 because of this on the weekly. And for those of you who are quite sharp, we'll be then taking, okay, Thiru, if it's all in an uptrend, but you're saying a top is about to form, why can't I short that? And which of it is going to become a top in that daily and sustain it and carry on further down to make this weekly a confirmed top with an orange arrow coming at the top and the orange dot coming through with our quantified formulas.
So Thiru, just looking at the weekly, is what point would the probability suggest that we're going to enter the next phase of a bull move up?
Good, very good question. I usually look at the 20% OE number. Anything that's crossed above the 20% OE, I would say is overextended and is going to make a top very shortly. Me personally, I don't like to trade phase 2s. I like my best setups are after the phase 2 finishes and then to capture the phase 1 before it begins. I always like to trade with the trend. But those of you who still want to trade that on a lower time frame, then what we then do is not only we look at overextension on a higher time frame, when I go on to the lower time frame, I look for a trend change. The main trend change over here, Jim, if you take a look, right, if I want to draw that there, is this low here, this blue line, which I've put at 2304, if I'm not wrong. Let me just bring up the data window here. Let me just see. Data window, it should be show data box. There we go. And if I were to do that, if I take the low here, that would be 2304, which I've drawn this line over here. So when it takes that out, right, that's when I get a trend change. That will give me more confidence. Another thing that Gavin and I usually when we trade, Gavin TradeGuide.com.
Thiru, real quick, when it takes it out, you mean a candle that closes below it?
No, just a break of that low. That's what we call the price structural failure.
Got it.
Not only that, some people, usually when I teach that, say, oh, Thiru, but I've missed all this move. Why am I getting in late, right? Late is always relative. I always say keep focus on how much move is left for you to capture. But for those of you who are a bit, want to get in a bit more earlier, there's a structured way of doing it. What we then do is what me and Gavin, whenever we trade on webinars, we always look at what we call the test. You see, when it took out that low, right? When it made that low, came back up, the real question is, Jim, is that high going to be the high which makes a lower high in relation to that show its first sign of weakness to carry on further down to then confirm this top to make a phase 2 on the higher time frame? That's what we're asking for. Now, if you want more confirmation and more confidence, then we go on more to the lower time frames, right? See what the lower time frames are telling us. So then, if I were to now, so the main really question now comes down to, if I want to nail it down, is this spot here and this high, is it gaining weakness, right? Is it having weakness to go further down and break that low? If I'm getting confidence from the price, then I can enter in earlier, expecting the probability to take out that low. So far, the good part is on the higher time frame, the higher guys will pull it down because of probability-wise, it will only a 5% chance of taking out the top, as I showed in the stats table, and you guys can look at the Tom's interview that I did as well. In detail, I go through that. Now, in terms of here, in terms of the 240 minute here, you can see over here that if I were to focus on this spot here, I zoom into that. Look at that, right? I'm just correlating all of that over here, right? And I'm observing this high here. Look at that. This is the most important thing I tell all the viewers looking at, and me and Gavin, we always look at this. Look at this spot where it did that, right? And it made a lower high. That gives you more confidence that the market is compressing and is showing weakness. So one earlier entry, if you don't want to wait for this low to be taken out, for the trend to change on the daily, one entry that you can take a look at is this one here, where the blue arrow is, where I've drawn that line over there. And that number would be 2331. So it's very near now. When you break that level, there's a first price structural failure on a 4-hour to go on the downside. Not only that, then also to break that low as well. And then if you marry that up with volume as well, you can see there's a big volume spike over here, but the volume dwindles away after that to show that there's weakness in this up move and for it then to come further.
So
well.
Thiru, that the low to the left, what if we don't break? Yeah, right. What if we hold there? What if we hold there and then you kind of translate that to the longer term chart? What does that do to the trend?
If the whole lows, which is in correlation to this low over here,
Yeah.
but then the next spot to really look, then it's compressing, isn't it? It's uncertainty there. But then the next level we look at, Jim, for market structure to change is this high over here, right? Is this high over here? If it does come back, you see, if it's consolidates here, if it does take out that high, then there's more strength towards the upside. But if it doesn't and dwindles, then you hold on to your position based on your objective.
Okay, so we would say that that's support and resistance defined right there.
Spot on, that's right. On market structure, on swing highs and swing lows, on the nature of market movement, which is it moves in cycles, right? And that's how trends are formed. The last time frame, and I put it all together and then we can probably wrap up over there, is this one here, right? So this one I've got here, over here. Let me move that there. That's on the 60-minute time frame. Again, if you observe, it's done that as well. It went up a little bit, did that, and then came back down, broke out all structures. Trend change was there. Gives you more confidence of the weakness. Not only that, I think I marked out the levels as well. So remember, so this is where, so to marry it all up, and then I show you the line diagrams I've drawn. That's your daily low, that's your daily low over there, and all that. The pink one is there, here. So you can see on its marry up over there. So you see this move here was a phase one on the daily. It did that, right? But over here is where it started to show its weakness. Made a lower high first. Took it out a little bit, right? Big volume spikes over here for you to start marrying that with price and see where it's going to come, which direction is going to come. The real clue is when you got a nice volume spike here by trade guided software there, and then into the salmon area, where then it takes out this price level, and that's when it breaks all price structures on the 1 hour time frame. And then all in marry up with the weekly time frame. So in terms of a line diagram, if I put all this together to put everything in conclusion, which is, let me show you this. This Word document here, which I've put it into all in a line diagram as preparing it, just to make sure that traders listening in really get this in time frame correlation and the market structure. So the weekly is doing that, right? Which what we saw, Jim. It's in an uptrend phase one. We are about here, very low open equity, very low move left to the upside. On the daily, if I focus on that point here, it looks like this. It's in a phase one as well, but it's making a lower high, right? Is that lower high going to sustain and take out that and change the trend is the question. If you want to enter earlier, you drill down into lower time frames on the 4 hour where it did that, took out that market structure, went into phase one, and again on the 1 hour is marrying up with that as well. So that's how we look at it. But the good part about looking at it in this way, you know exactly which part of the phase you are, which part of the cycle you are, which part in the higher time frames you are at, so that even if you're taking a shot on the lower time frames, you don't start to have this dream that downtrend is going to go on forever, because the big boys are going to come in again on the higher time frames and pull it back into this trend again. So it makes you wary of where your target objectives are going to be and what the concept of your strategy. And that is what I will end off with, which is the main points. What I really want to you all to take away is market structure is not the end all be all. Market structure gives you a good framework. And with that framework, how you use the market structure to then build your entries and set your target is what strategy construction is all about, right? And then how you have your formulate your concept and your objective is all must be well defined. And that's how we build our strategies and publish our results all in real time, Jim.
Okay. And this could have been, I mean, we just picked gold, which is in a bullish market. It could have been a bearish market. It could have been in a different market. And you would do the opposite.
Spot on. But remember, you know, what I showed you in gold over here on the lower time frames, I can take a shot, right?
Yeah.
Because on the lower time frames, it will start to show you, see, look, it starts showing you down, and people, if they don't understand time frame correlation, they start thinking, oh yeah, this is a bearish market. Let me just shot the hell out of it and be on it forever. But just being wary, if you now you know time frame correlation, even though I may short it in the lower time frames, I'm wary of the higher time frames, that it might come back into its uptrend back again on the weekly.
So, Thiru, let's talk. I wanted to ask you about 7 steps to achieve consistent trading performance video course. I know that's we have a couple minutes. I just wanted to let you talk about that.
Yeah, you know, everything what I've talked about here, and also in the interview with Tom that I did, which got really very popular. I mean, within about 2-3 months, it got 25,000 views.
But hang on a second. Now what you're doing. So I can't. If I'm going to compete with Tom, you got to stop plugging the old video, because he's going to get more page views on the old video, and I could never win the contest.
Jim, I've started to understand, not only in trading and anything you do in life, it's not about us. It's always about the viewers and what the best value we can give them.
I know.
It's okay. It was nice. I got to keep reminding myself that all the time. Coming back to 7 steps, guys, I mean, this is the video course we put together. A lot of research that we put in. Just so definitely get hold of that. Let me see if I can find a video page for that or not. I'm not sure if my team is.
And by the way, Mission Control is going to cut and paste this in both the chats, so you guys could see the link to this webpage.
Yeah, that'd be great. That'd be awesome. Yeah. Anyway, I think when they put the name and email, they will get that. I mean, many years of research we put together, but I just wish that you guys really get good value and you're able to put time frame correlation and market structure really well into good use.
Absolutely. I'm going to do, as soon as we're done here, I'm going to log on to this website. I'm going to get my free trial.
Oh, nice. I like it. Yeah, definitely high value over there. Very good.
Yeah, no, for sure. Well, I really appreciate you being here with me today, for sure. I know you're super busy. We're probably in the evening hours over there.
Yeah, it's coming into 4 p.m. Late afternoon. I'll probably catch a cup of tea after this. Nice English tea. Yes. Yep.
All right. Well, I appreciate you being here with me. Looking forward to having you back if you're so willing.
Definitely. I'm always very happy to serve you ninja traders out there. And I really love the charting software. It's really good. Well done to you guys.
All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.